But let's be clear, and I really want to drive home this point, is that what happens in one sector affects others, right? This is a system that is tied together. And as one sector begins to degrade, it brings down other sectors, primarily the banking sector. So when you have real estate, commercial real estate, and we don't go into it here, I think every sort of country, every sort of incident may have its own unique situations. I think in Germany, there's sort of an implication where there might be a little bit of fraud going on there. In Evergrande, in China, there might be a situation where there was an attempt to prop up, the government tried to prop up their own economy by building. Here in the U.S., it's about a change in the way business is being done. Businesses, particularly in places like New York, where it's very expensive to have office space, people are not going back. They're walking away from their leases because folks are not coming into work. And it's easier now with the technology to just pay people remotely to do their work and not actually have to go in and pay that rent, pay that overhead. And part of what's going on here is last year, we came very close to having a banking crisis and the only reason why we didn't is because of Dodd-Frank. And the only reason why it won't be as severe as '08, if we do have a full-on crisis, is Dodd-Frank. Through Dodd-Frank, thank you, President Obama, you've got this requirement for these banks to be stress tested. They have to show they've got the money in their bank should loans go belly up. However, there was a change during the Trump administration that allowed smaller and regional banks to be able to not have to be stress tested. Well, what happened last year is those banks turned out to be not properly collateralized, and they went under. Signature Bank, Silicon Valley Bank. These banks were not able to deal with a run on their banks, and when people got wind that there was a problem in the banking industry, what happens? You run to your bank and you try to pull out all your money, and that is a quote unquote run on the bank. And when that happens, banks who are not properly collateralized because they have their money elsewhere, they have to shut the doors on people, and that causes a panic within the banking industry, and other smaller banks begin to start to falter. People start just to be safe, they go to their bank, their regional bank, and they pull out the bulk of their money. So the contagion is in part the fear, whether it's true or not, that your bank may be not properly collateralized, not have your money. And that fear drives a run on banks, and banks that are not really properly collateralized, they don't really have the money sitting there in the bank, they start to buckle. Welcome to today's show. I am your host, Eric Darnley Small, and just to get it out of the way, if you guys are watching this video, you should know by now that one of the things I do is I will show links to and show my homework as to what I'm talking about on today's show. And you can find the full links to the articles at our Mastodon at mastodon.vtip.me/@ what you missed. And what's important about that is that you'll be able to read the full articles and see for yourself. What I'm going to read here today is going to be a summarized version. So I only take out the bits that I need to sort of give you my take and my view and to bolster my argument. But I encourage you to go and check it out for yourself and read what these articles say. Also support those articles, those writers and those publishers. In addition, if you find what you see here interesting, please, I would urge you to like and subscribe to the video and to the channel. And that will notify you. If you click on that bell, it will notify you when new material comes into play and becomes interested. So on today's video, I am focusing on the question of whether there is a worldwide real estate crisis imminent. And it's an important thing to talk about. Again, what you missed, this channel is about talking about those things that I don't think are making a lot of news, regular news. I think it's probably interested if you are segmented out. For instance, if you're into business, if you're into real estate, if you're into, maybe you're hearing about some of these things. If you're into international news and whatnot, you're hearing about these things. But on this channel, I want to bring those things in and talk less about the breaking news and what everyone else is talking about. But of course, as you can imagine, I have to talk a little bit about the breaking news, and I have to, and I'm going to do this because this is important, and this reflects on what I'm talking about what I think is happening in real estate. So on the topics for today, a new candidate for 2024. The big news out of from yesterday. From Sunday is that Joe Biden has stepped out of the race. Kamala Harris has stepped in, and there was a coalition around Kamala Harris in the Democrats. So what does that mean? What is that going to portend for the Democrats and for the elections? I want to talk about that. And what they could be facing come election time, whether it's Trump or Harris. Then I'm going to talk about the real estate market. Investors are trying to pull out of real estate funds. What does that really mean? What is that telling us? Hidden debt in China threatens its future. A report that half the U.S. banks are in trouble. Elizabeth Warren sent a warning to the Fed about attempts to weaken Dodd-Frank. And my final thoughts on all of that. So let me run into this. As you guys know, that I try to keep this video short and simple, but that doesn't end up being the case all the time because there is a lot to get into. So the new team for 2024, it's going to be Harris and whoever she chooses. And this is my opinion on the race for 2024. And the new change in Harris being the new nominee does three things in my mind. It changes the narrative from the age of the Democratic candidate and the stumbles, and puts the narrative on the Republican candidate's age and the stumbles. Already there's been talk of Morning Joe going out there and talking about now Donald Trump is the oldest person in this race, and that is true. Again, I've talked about this before in previous videos, that the age issue was becoming a wound that would not heal, and we know that Biden became aware of that. Democrats started going out there speaking to him directly because this was really not getting better, it was only getting worse. So I think, as everyone has said, Joe Biden is truly a statesman. You know, this is the most powerful position in the world. And normally people don't want to give up power, right? When you have the level of power as president of the United States, you are not incentivized to give that up. And to have a man who is willing to give it up shows that he truly was willing to put party and country over his own ambitions. There's been a lot of talk of American exceptionalism. I have said previously, particularly on this channel and other videos, that I thought it was a first cousin to white supremacy and Christian nationalism. It is one of those things that I felt always existed because particularly conservative Republicans felt that there was something special about America, something Christian about America, something so special that God has blessed America, that he can go around and tell other countries what to do and how to do it. And I have always felt that that was something that had a racial component to it, as well as an arrogance component to it. And I never believed in it until today. What's exceptional and I think is unprecedented in the world is not just what happened on Sunday, but everything from the debate going forward. And just to summarize, he had a terrible debate, a disastrous debate. He was in denial about it, refused to even look into it. And the Democratic Party gave him 2 weeks to look at his debate performance, to try and turn things around and look at the polls. They did that. They continued to go to Joe Biden and report back, which is what he requested, to report back what they were finding. And Joe Biden saw what he saw and realized, you know what? I am going to put country before myself. And in doing so, he sent out a statement saying that he was going to not run again in 2024 in this election season. He fully endorsed Kamala Harris. And then the Democratic Party, within hours, immediately pivoted a full 90 degrees pivot towards Harris, embracing her. There was talk along the way about how the Democrats wouldn't embrace her because she was as bad as Biden, and according to the polling, that they wouldn't vote for her. People wouldn't vote for a woman, a black woman, etc., etc. But all of that melted away, as far as I can tell. Even Joe Manchin, who had come out and said he would think about re-registering as a Democrat and running for the nomination, which was a joke, which is hilarious in its nature. Even he, by Monday, today, pivoted and decided he would not run against Kamala Harris. So that is exceptional. That is not something you see in other countries. That's not what you're seeing in our other party. And that is in itself what makes American exceptional. So I'm a convert to American exceptionalism because of what I've just seen for the last couple of weeks. But let me go back to my bullet points here, in my opinion on the race and what this does, what I believe that the calculation does by Joe Biden stepping down and Kamala Harris stepping in that slot. As I said, it changes the narrative. It gets rid of that wound that wouldn't heal over the age issue. It also takes the Trump campaign off its game. Now the campaign has to reorient, and you have to wonder, can it do it? Trump was getting compassionate conservative thanks to the assassination attempt. This now removes that story from the headlines. We know Trump is worried about this because he already sent out on his Truth Social website that he felt like he should be reimbursed for all of the money that was spent going after Joe Biden, which was hilarious, of course. Enthusiasm returns to the Democratic Party. Democrats who were losing it, but now it is back as everyone coalesces around Harris. The Democratic base is once again engaged. One of the biggest concerns that I had from a lot of the reporting was that you couldn't get people to go out and volunteer for Joe Biden because they were so discouraged. Now that appears to be changing from what all the reports are saying. One of the interesting tidbits that I had heard was just over the social media, young people were now able to take clips from Kamala Harris because Joe Biden, you couldn't use the clips because the man stuttered and stumbled so much, like I just did. So it's very hard to put together clips and do it within a short period of time and be able to put together a coherent message. Kamala Harris now allows that to happen very easily for anybody. Of course, professionals can do it, but for anybody who has a TikTok channel, they now can do it easily. I think the timing helps. Some people are saying the timing doesn't help. But I think, again, the news cycle will be about Harris's running mate now, which will dominate the news media. Although we want to keep a focus on Trump and his antics, the contrast could look strong for the Democrats. As things begin to focus towards the Democrats, I think it's to the advantage of the Democratic Party that this is happening now. There was a reporting which I found compelling, that Donald Trump may have peaked too soon. That was the headline of the article. I don't know that is the fact, but it's an interesting and a compelling argument to make that he may have reached his ceiling and now it's just down from here. So that's interesting to think about. And because of the late start for the Harris campaign, the opposition research is going to be tough on both her and her opponent, her running mate, which I think is going to be interesting to see. We don't know also who her running mate's going to be, so it's going to take time for them to find oppo research. There are challenges, of course, as with any. We have to wonder how good of a campaigner is Harris. Her run for president and her first year as vice president was seen as a disaster due to her team. Has she gotten better? Listen, it wasn't that long ago that there was reporting that the Democrats were trying to remove her from the current administration because they were so concerned about her bad polling and her negative views that people had on her. Of course, to our advantage. Now she's been out there on the campaign trail, taking it to Donald Trump over Dobbs. So she appears to have improved in that area, and she's not an unknown quantity because of that. What are the skeletons in her closet? How much do we know about Harris? Again, that goes into this issue regarding the Oppo research. Is America ready for a black female president? Polling says that Michelle Obama beats Trump. People appear to be ready. There's going to be a lot to say about a woman, a black woman in particular, and the attacks that Trump and allies are going to level at her for her race and for her gender. I mean, that's a double whammy. Is America ready for that? There is polling, like I said, regarding Michelle Obama. She trounces Trump. So apparently for her, a race and gender doesn't matter. So why would it matter so much for Kamala Harris? I don't know. We can forget about the white working class male. Obama lost them. Biden won them back. Harris will surely lose them. Mormons who had been resistant to Trump and supported Biden are unlikely to support Harris. Again, unfortunately, it's the race issue. I think it's also the gender issue with Mormons. Mormons had been one of the few evangelical, quote unquote, groups, white evangelical groups that had been resistant to Trump, surprisingly resistant to Trump. Utah is basically known for Mormon country. They had been sliding, as I reported on my last video, away from Biden. I think this is going to make the slide even worse. I would be very, very interested in a polling regarding Mormons alone. I think that will say a lot as to how much race is going to factor into this, just the view of Mormons. And either nominee is going to have to deal with a potential crisis on day one. It's the reason why I did not believe Project 2025 was going to be the threat others were making it out to be. The next president's going to have a huge crisis on their hands. And that's the focus of the video for today. Again, I don't want to give short shrift to Project 2025. It's a serious issue. It's something that needs to be talked about and discussed. And I would encourage anybody on the left to talk about it. Kamala Harris needs to talk about that a great deal, but connected, of course, to Dobbs and to abortion. But I've said to people privately that every president comes in thinking that they're going to change Washington, are going to remake Washington, going to remake the presidency in their own image, and all of them fail. One of the reasons why is external factors. For George Bush, it was the war, and it was 9/11 basically, and the Afghanistan and the Iraqi war sort of really prevented him from doing all the radical things he wanted to do. For Obama, it was the 08-09 crash that really prevented him from doing a lot of things. For Trump, it was COVID. So, it is one of these situations where no matter if it's Trump or Harris, I suspect that something's going to happen economically that's going to really turn things around. And that is the focus of this video. As I've already hinted, it has to do with real estate. I think what is the next crisis? There are warning signs. What is going on with commercial real estate? And this is both a national and international story, as I discuss. But I want to begin with the stock market and what are called ETFs. And they can give us an idea of what's going on. And this is a reporting out of MarketWatch. Again, you'll be able to find links at Mastodon. Investors are pulling money out of commercial real estate. And it says, as the rush to exit commercial real estate goes mainstream, more mainstream funds are putting up gates to limit withdrawals. And the article goes on to say, and actually, this is a little bit of a research. What is an REIT index? And REIT stands for Real Estate Investment Trust, ETF. And they are exchange-traded funds that invest in a majority of their assets in REIT securities and related derivatives. REIT ETFs are passively managed around an index of publicly traded real estate owners. Even with a challenging market, REITs are considered a staple for many investment portfolios thanks to the 90% rule. As the name implies, this rule stipulates that real estate trusts must distribute 90% of their taxable earnings to existing shareholders. So these are funds that are investing heavily in real estate. And they are desirable because of their excellent dividend, because by rules, they must have their taxable income passed on to investors in the form of dividends. So the dividends are incredibly high. So you're getting a lot of money from this fund in the form of a dividend payment every quarter. So, but what's important here is that because it's so leveraged to real estate, that looking at how these funds are performing and what they're reporting back gives us a good indication of how the real estate market is going, particularly commercial real estate. And it says the plight of investors looking to pull money out of commercial real estate funds has gone mainstream. Big name property funds like Barry Sternlicht's $10 billion Starwood Real Estate Income Trust have been scrutinized for limiting investor withdrawals from niche funds that exploded in popularity among the well-heeled over the past decade. But investors with millions of dollars at their fingertips aren't the only ones frustrated by funds putting up gates. Outflows and redemption queries also have been piling up at mainstream funds. Quote, "A lot of investors are wanting out, but there are minimal distributions," said real estate consultant Scott Maynard, a senior vice president at Makita. "Until we start to see transactions pick up, we will see redemption queues in place." Queues have hit roughly 95% of the commercial real estate industry's benchmark Odyssey index, an equivalent to the S&P 500 index, according to a person with direct knowledge of the matter. Odyssey funds have been swept up by the same higher borrowing costs, falling property prices, and wave of maturing debt that has roiled the broader market since 2022, when the Federal Reserve began jacking up interest rates to a 2-decade high. A portfolio manager at Russell Investments said investors waiting in redemption queues have been receiving payments in drips and drabs since reduced transaction volume put pressure on liquidity at many core open-end funds. The U.S. has about 2,400 commercial real estate funds dedicated to the 5 main property types comprised of office, industrial, retail, and hospitality. The Fed's policy rate was close to zero during the COVID crisis and near historic lows for much of the past decade, a period in which most of the estimated 4.7 trillion pile of outstanding property loans were originated. Typically, when a fund puts up gates, it works something like this. An investor with a 100 million exposure to an index might put in a 10 million quarterly cash out request. Redemption limits, however, mean that they might receive only 1 million back. "I don't think it's all doom and gloom," Sarah Cassidy, head of portfolio management at AEW's private equity group, said, adding that pockets of commercial real estate outside of office have held up well, and there's a lot of dry powder on the sidelines that could be deployed if investors feel prices are near a bottom. "I don't know that it's going to universally solve everybody's problems," Cassidy said, "but I don't think everybody's portfolio is problematic." So, what's going on here? I would surmise, and this is from July 8th, 2024, I would surmise that this is an indication, not so much of anything so bad yet, but it is one of, if you could add up a cascading effect, this is one indicator that there is a problem afoot. We already know from a previous video that I showed at the head of this, we already know, and that goes back to February, that I had at the beginning of this video. I reported and I talked about articles showing that China, parts of Europe and America were having stress hit the financial industry, the real estate industry, and the banking industry, because it's so connected to the real estate industry, that these indicators point to a problem, a big problem in real estate, both international and nationwide here. So that article, Market Watch, back in July, is one of the pieces in this cascading effect. And it's beginning, it's like the canary in the coal mine. This is the beginning. These ETFs are beginning to see people trying to, it's almost like a run on the bank. They're trying to see people cash out of this. So they're actually putting people in queries. Queries are basically like if you've ever been on a line, or if you've ever called a business and they put you on hold. That's what a query is. And what's happening is these ETFs are getting so many people trying to pull out of them that they're having to prevent a huge run on these ETFs, people pulling out of these ETFs, that they're stifling or they're stopping huge outflows by creating a query so that if you ask for 10 million, you get one. And that's an indication of a problem in this ETF, and this ETF invests heavily in the real estate industry. So there's a problem in the real estate industry where they can't meet the demands of people wanting to pull out. So that is one canary in the coal mine, let's say. So let me talk about this next one that goes to my point. And it is, again, we're back to China again. And it says, this is an article that says trillions in hidden debt drove China's growth. Now it threatens its future. And it says local governments racked up as much as 11 trillion in off the books debt to build industrial districts, resorts, transit systems, and housing projects, including many that failed. And it goes on to say, and this is out of the Wall Street Journal. This is July 14th, 2024 by Brian Spiegel and Rebecca Fang. And it says officials were bullish about the future of their factory town in early 2019. The economy was prospering, a new industrial district was on the way, and an elevated light rail system was taking shape. For years, Luzhou and scores of other Chinese cities together amassed trillions of dollars in off-the-books debt for economic development projects. The opaque financing was the yeast that helped China rise to the envy of the world. Today, overgrown construction sites, sparsely used highways, and abandoned tourist attractions make much of the debt-fueled growth look illusionary and suggest China's future is far from assured. Luzhou, a city in the southern region of the Guangxi, raised billions of dollars to build the infrastructure for a new industrial district where a state-owned financing group acquired land and opened hotels and an amusement park. Other tracts of acquired land sit vacant, and many area streets look practically deserted. Birds flitter through the rows of abandoned buildings at the unfinished apartment complex. The government is broke, said one local resident who watched the project falter from her shop across the street. At the end of the mess are the complex state-owned funding vehicles that borrowed money on behalf of local governments, in many cases pursuing development projects that generated few economic returns. The deterioration of China's real estate market in the past 3 years meant local governments could no longer rely on land sales to real estate developers, a significant source of revenue. Economists estimate the size of such off-the-books debt is somewhere between 7 trillion and 11 trillion, about twice the size of China's central government debt. The total amount isn't known, likely not even to Beijing, say bankers and economists, because of the opaqueness surrounding the financial arrangements that allowed the debt to balloon. As much as 800 billion of that debt is at a high risk of default, economists say. If the financial vehicles can't meet their obligations, Beijing could either pay for bailouts, which might create a bigger problem by encouraging unsound borrowing, or it could allow insolvent funding vehicles to go belly up, exposing Chinese banks to serious losses and potentially spurring a credit crunch that could further erode economic growth. Other cities are also scrapping infrastructure projects, which have long driven much of China's growth. Moody's Investors Service and Fitch Ratings lowered their outlook on China's credit rating to negative from stable, largely because of doubts that local governments can properly service their debt. The reckoning has arrived, says Victor Shi at the University of California, San Diego. who researches China's political and financial system. The municipal debt dilemma grew out of a fundamental weakness in how China's cities fund themselves. Deficit spending provided one solution. Chinese cities discovered decades ago that they could take on debt through state-owned entities known as local government financing vehicles, or LGFVs, to fund sewers, streets, and the like. Because the debt didn't appear on government ledgers, only on LGFV books, cities were able to sidestep borrowing limits. How LGFVs worked. LGFVs raised money from loans and bonds. The money is used for projects or to buy land for development resale. The LGFVs earn money when the projects make money or the land is sold. If the LGFVs don't make a profit on the deal, the LGFVs struggle. When China's property market crashed, this is exactly what happened. Many of the projects funded by LGFVs turned out to be ill-conceived, ill-timed, or both. Rohindam Group, a research firm, found that only a fifth of the nearly 2,900 LGFVs it reviewed last year had enough cash to cover their short-term debt obligations and interest payments. Late last year, China's Ministry of Finance publicly criticized Luzhou for its debts, calling out 8 city leaders and LGFV executives. In addition to the arrest of former mayor LGFV Don Chang's former chairman was charged with taking bribes. The scrutiny hasn't stopped the city's LGFVs this year from ordering the issue of 9 bonds totaling $647 million. On a Communist Party-run message board, a resident complained about the construction fences still bordering the abandoned light rail project. The fences blocked the sidewalk that residents wrote forced pedestrians to walk into the road. Guangxi Laozhao's rail transit, the LGFV responsible for the project, responded candidly to the online post. Quote, "Due to the tremendous financial pressure on our company recently, we're not able to tear down this part of the fencing," it said. "Thank you for your concern." So, what is going on here? What's going on here, in my view, is we're seeing something similar like we saw in '09 and '08 here in the U.S. In that case, it was called credit default swaps. And this was a great deal of debt on banks' ledgers that were hidden because of the nature of this instrument. And there were assumptions that made these instruments compelling. One of the assumptions is that mortgages, of which these default swaps were based on, would never go insolvent and would never go under. That, of course, was not true. And as soon as people started defaulting on their mortgages, all of these default swaps started collapsing. They were also AAA backed by insurers that did not do the research that they were supposed to do. So it took down the insurance industry of that sector. Also took down Moody's and all of these other ratings agencies. That appears to be happening right now in China with these LGFVs. These are off the book, very opaque financial instruments that in local China, in cities in China, they were using to create bonds. And what are bonds? Bonds are basically loans that a government asks the people to give them money so that they can basically invest in the debt that this business incurs. So in this case, it's usually institutions. And in this case, it's usually other stockholders, usually rich people who are looking to make money on the debt and feel like it's a safe bet. They'll buy bonds. And what these LGFVs did is they took that money and invested them, but those investments are going belly up. It's exactly what happened basically in the US in '08, '09. That appears to be happening now in China. Moving on, we have a report that says half of the large US banks are failing on operational risks, secret report finds. And this report was done by the comptroller of the currency. And he testified on Capitol Hill last week that in a confidential the OCC assessment found that half of the large banks it supervises have an inadequate grasp of operational risk. And this is from Fortune magazine online, July 21st, 2024, by Hannah Levitt, Katanga Johnson, and Bloomberg. And it says, a key U.S. regulator has privately found half of the major banks it oversees have an inadequate grasp of a broad swath of potential risks, from cyber attacks to employee blunders, according to people familiar with the matter. In the confidential assessment, the Office of the Comptroller of the Currency said 11 of the 22 banks it supervises have, quote, insufficient or, quote, weak management of so-called operational risk, said the people who asked not to be identified because the information isn't public. The scores are the latest sign that U.S. regulators are concerned about the level of risk at the country's largest banks in the wake of a series of failures last year. Operational risk is one of the categories by which regulators evaluate overall risk at the banks they oversee. Each bank's individual ratings are closely held, but regulators sometimes use aggregate data on banks' grades to highlight areas of concern in discussions with other agencies and the industry. The harsh grades are part of sweeping regulatory scrutiny in the wake of the record-setting bank failures last year, after the regulators vowed to do more to identify and act on problems. The OCC's large bank portfolio ranges from regional lenders with at least $50 billion in assets to the mega banks with trillions. Last year, the OCC, Federal Reserve, and Federal Deposit Insurance Corp released guidance for banks on how to mitigate risks from third-party vendors. The agencies said that, quote, the use of third parties, especially those using new technologies, may present elevated risks, and instructed firms on how to monitor their activities. The agencies doubled down earlier this year, issuing a warning on the use of outside artificial intelligence tools. So what's going on here? Well, what's going on here is that banks are having a problem of it. And what's interesting here is it's not even talking about its connection to the real estate industry and how real estate is causing pressure on banks. We already know that exists. We knew that last year. That's the reason why we had a number of bank failures. But this is a new mitigating factor, let's say. This is a new issue that exists within the banking industry that just says that banks are not prepared for certain types of attacks, like a cyber attack or a mistake made by an employee. So what does that mean? That means if we do have a disastrous situation with regard to real estate here in the US or around the world, the banks are going to have an issue with that. But in addition, they have this other issue that's going to happen with just being able to be operational, which means that if these two things hit at the same time, it's going to be like the Titanic. I mean, this could be a 1-2 punch that could bring down the banking industry. The banking industry is already vulnerable. We saw that last year. I did a video, again, at the head of this video, where I talk about, and Janet Yellen testified in front of the House, that they are seeing what's going on in retail real estate, in commercial real estate. They know that there's a problem there, and they're mitigating against it. They're trying to do something about it. But in addition, this new reporting from OCC, which is a part of the Treasury Department, is saying that there is this additional risk that exists, and that is operationally. So these two things, God forbid, could become a 1-2 punch and could bring down a lot of the big banks and a lot of the problems, and cause a lot of problems that we haven't seen since, again, 08, 09, Great Recession. In addition to all of that, we have somewhat of a war between Elizabeth Warren and Jamie Dimon. And Senator Warren warns Powell against weakening bank regulators, and she says, do your job. Now, that previous report was just yesterday, was on the 21st, about what the OCC had just discovered about this operational issue going on. Cyber, we just had this CrowdStrike thing that happened over the weekend that could affect the banks, and it has affected the banks, right? Operationally, they would not be able to deal with 11 out of the 22 banks, half of the banks that the OCC looks at, is unable to deal with and unable to manage these issues. So here is, in addition to there being an actual contagion within the real estate industry, here is another problem that exists. A bad actor or a mistaken plug-in could bring down the entire banking industry. In addition, you have pressure by banking executives like Jamie Dimon who want to weaken the rules over Dodd-Frank. Warren asked Powell for a response to reports that, quote, you are advocating for slashing in half the increase in capital requirements under the proposals. Now, as I just read a minute ago, there are these rules that were written for the by the OCC for guidance. It says last year, the OCC, Federal Reserve, and FDIC released guidance for banks on how to mitigate risks from third-party vendors. So what Warren is talking about here is further guidance that are going to go into these other issues like capitalization and all of that. And she is learning that Powell is meeting with bankers to weaken those rules. And again, we know last year that the Trump administration had weakened the capital requirements on regional banks, and the regional banks needed to be rescued by FDIC just last year. So I'm going to go into this article. This is from CNBC. This is July 18th. So, a few days ago, before that previous article about the OCC report. And it says, Senator Elizabeth Warren of Massachusetts is accusing Federal Reserve Chair Jerome Powell of doing the financial industry's bidding by considering changes to a sweeping set of regulations aimed at boosting capital cushion that large American banks would be required to hold. Quote, I am disappointed by press reports indicating that you are potentially intervening after numerous meetings with big bank CEOs to delay and water down Basel III capital rules. Quote, these rules are critical and long overdue, particularly in the wake of the Silicon Valley and Signature Bank failures, and as risks from the weak commercial real estate market and other economic threats ripple through the banking system, Warren said. Bank CEOs and their lobbying groups have said the increases are unnecessarily aggressive and would force the industry to curtail lending. In March, Powell told lawmakers that he expected broad and material changes to the proposal in the wake of the industry's campaign against the rules. JP Morgan Chase CEO Jamie Dimon coordinated efforts to weaken the rules, urging CEOs to appeal directly to Powell, the Wall Street Journal reported last month. Quote, it now appears that you are directly doing the bank industry's bidding, rewarding them for the extensive personal lobbying of you, Warren said in her letter. Taking orders from the industry that caused the '08 economic meltdown would sacrifice the financial security of middle class and working families to line the pockets of wealthy investors and CEOs. She further criticized Powell, saying regulatory rollbacks under the Fed chair allowed the regional banking crisis of 2023 to happen and enrich Jamie Dimon and his Wall Street cronies. Warren urged Powell to allow the Federal Reserve Board to vote on the original tougher Basel proposal by the end of this month. The window to finalize and approve the rules ahead of the U.S. elections in November is closing, and analysts have said that the proposal could be delayed or killed if Donald Trump is reelected president. Quote, instead of doing Mr. Dimon's bidding, you should do your job and allow the board to convened for a vote on a 16% capital increase by June 30th, as global regulators determined was necessary to prevent another financial crisis, Warren said. When asked for a response to Warren's letter, a Fed spokesperson had this statement on Tuesday morning: "We have received the letter and plan to respond." So, final thoughts. What I'm seeing. So there's a number of things that I'm seeing. Number one, there's this problem with REITs, as I've indicated. Real estate funds are very popular. Real estate real estate ETFs are popular because they are required to pay to the investor a huge dividend. The equity research, the payout, that is the percentage of net income that a company pays out as dividends, a payout ratio of 20% means for every dollar of net income, 20% is being paid to the shareholder in the form of dividends. But the payouts are not generated from the company's earnings, but from taxable income. These ETFs can give us insight to the state of the real estate sector. As I indicated before, the ETFs are a canary in the coal mine. How they perform gives us an idea of how the real estate sector is doing. And right now they're accused because people want to get the hell out of them. And these funds are blocking people from pulling out too quickly a quote unquote run on these ETFs. That indicates bad things are happening, I think, in commercial real estate. Also, what's happening in China, particularly in this province, looks eerily like the credit default swaps that killed the banking and housing industry in 08-09. As I already mentioned, China's government appears to have allowed debt to go crazy thanks to an exotic funding mechanism used by local governments called local government financial vehicles. Like default swaps, when the underlying asset goes under, loses its value, the LGFV also suffers. And I'll add, just like with credit default swaps, nobody had an idea of how much of this stuff was out there. And you had economists and others having to guess as to how much of this debt was out there. We also got some lessons out of 08-09. Banks, when not properly regulated, will overspend. The real estate and banking industries are tied. As one goes, so does the other. Stocks heavily invested in real estate expecting good returns are vulnerable. Banks that invest in risky loans are vulnerable to contagion within the real estate industry. International economies are linked together. China's economy is closely linked to the U.S. So you might be saying to me, Eric, what the hell do I care about what's going on with these banking solutions in China? Well, China and the U.S. are inextricably linked economically. And we need to know that, and we need to appreciate that, because of if China goes, as China goes, so does the U.S. It's very important that we make sure that we understand what is going on with China financially, and nothing good is happening in their real estate industry. The banking industry is still in crisis. According to reports, half of major banks have inadequate safeguards in place for everything from a cyber attack to an employee mistake. If true, that means an exotic type of financial instrument invented by the industry might be flying under the radar as well. So if there is a national or international emergency in an industry tied to the banking industry, like real estate, will banks be able to contain the problem without dipping into government and taxpayer funds? I can tell you the answer to that is no. We know that happened last year, and FDIC had to come in and rescue these banks. But now we're talking about, those were regional banks, smaller banks. Now we're talking about this issue with respect to what the OCC discovered. They discovered in huge banks, big banks, $7 and $11 trillion banks. These are huge, huge banks. And if they go sideways, that's a huge, huge problem. According to Elizabeth Warren, the banks think capital requirements are too onerous. Warren's letter to Powell seems to indicate that the banking sector is working overtime to weaken Dodd-Frank capital requirements, and even more. It's just shocking given what happened to regional banks who did not have capital requirements and they suffered and had to be taken over by the FDIC. And then the end of the Chevron doctrine. Again, the Supreme Court is a gift that keeps on giving, or a curse that keeps on giving. The Supreme Court has given itself power over the administrative state by doing away with Chevron. That means the ability for the SEC and the Fed to police banks will be challenged in court, and this will lead to uncertainty in the sector and is sure to hamper the ability for the government to prevent an '08 or '09 style crash from occurring. And finally, this is the problem I see with a Trump administration. I haven't done an assessment on what a Harris administration would look like, except that I know that they would not be fully on board with turning things over to the rich folks in the world, the banking industry, for instance. But we know Trump will. Trump is in the pocket of big business. He could not care less about the ill effects of his decisions. If he gets into office and interest rates are still high, how much do you want to bet that Trump demands that the Fed cuts rates in order to prop up REIT funds and correct the collapsing real estate market? Doing this will cause inflation to come roaring back and will harm average Americans. The government will have less money in the bank as Trump cuts rates and taxes. This will also cause the government to incur more debt. If the Senate and the House are in Republican control, savage cuts to social services, which will bring pain to average American, will not solve the problem at hand. Trump has already floated Jamie Dimon as Treasury Secretary. Elizabeth Warren says Dimon is working to weaken Dodd-Frank rules, and weakening Dodd-Frank rules will make the bank failures catastrophic as the Fed is forced to rescue more banks. So there you have it. That's my prediction on what will happen if Donald Trump becomes president. Project 2025 is frightening, is scary, but I think that this is the more likely thing that will happen. A real estate and banking crisis will happen, and Donald Trump will sit back, just like with COVID, and do as little as possible, or at worst, make things worse. So that's my prediction. Hopefully it doesn't happen, and hopefully things work out okay. Thank you for joining me on today's video, and you'll see me on the next one. Take care, everybody. Hey there, fantastic viewers. Eric Darnley Small here, and I hope you're loving today's episode of What You Missed. You've reached the end of today's show, but don't worry, there's more show coming up. If you're watching this on YouTube, please click the bell so that you'll be notified when more content is available. You can also help the channel by clicking the like and subscribe buttons. It helps the YouTube algorithm find new viewers so that I can keep bringing you all this incredible content you enjoy. But wait, there are more ways to support the show. You can make a contribution through the show's PayPal, which goes a long way in helping produce even better content for you. And consider becoming a part of our growing community by joining our Mastodon site at mastodon.vtip.me/@whatyoumissed for more engaging discussions and exclusive updates. And here's something you won't want to miss. Mark your calendars for our live show streaming on YouTube and stream.vtip.me Monday mornings, 10:30 a.m. Eastern Standard Time. Your support means the world to me, and together we're making What You Missed the best it can be. Thanks for being a part of my journey.